Life insurance. What's the first thing that comes into your mind when you think about life insurance? For most people, it's the death benefit. When it comes to the death benefit, most people think, what's the most death benefit can I get for the least amount of premium? Well, even though you are the richest guy in the cemetery, that money was meant for your beneficiaries. It wasn't meant for you to use while you were alive. I thought we should just take a moment and let's look at the different kinds of life insurance and how it can work for you.
There are really only two kinds of life insurance: temporary coverage, which is called term insurance, and permanent insurance. Both term and permanent life insurance comes in various different shapes and flavors to satisfy different needs. Term life insurance is, by definition, temporary insurance. It's designed to provide coverage for a limited period of time, typically 10, 20, or 30 years. Term policies are simple and extremely inexpensive. In most cases, your cost each year is guaranteed to remain level for whatever the term is. Again, typically 10, 20, or 30 years. After the term is over, make sure you're sitting down when you receive your premium notice, because your rates are going to jump up dramatically, sometimes by a factor of as much as 10 or more.
Let me interject something here. 97% of term insurance is never used. Those premiums are just gone. A $250,000 20-year term for a 40-year-old man costs him a total of $10,000. And remember, 2 to only 3% is ever used by the insured. So that's a pretty good bet for the insurance company, don't you think? No wonder it's so cheap.
Permanent life insurance is designed to provide coverage for as long as you live. If your needs are long-term, like estate planning or final expenses, or if you just want to leave a bigger legacy no matter when you die, permanent insurance is probably the way to go. There are lots of different kinds of permanent insurance, but the two primary categories are whole life and universal life. Universal life insurance, one kind of permanent life insurance, offers a certain amount of built-in flexibility. You have the ability to change your premiums and death benefits to keep pace with changes in your life.
Universal life policies use the stock market to generate cash values inside the policy, and as we get older, the cost of insurance rises. So the cash value inside the policy covers those costs. But if the market goes down, then either your premiums go up for the same death benefit, or the death benefit goes down for the same premium. And remember, these premiums are not guaranteed, and in fact, they might become too expensive later in life, and people sometimes have to drop the policy.
Whole life insurance is what I refer to as the Rolls-Royce of life insurance. Over time, these policies develop significant cash values that are guaranteed and can be accessed at any time. Regardless of what happens in the economy, each year the cash values grow, guaranteed. My whole life policy, for example, I bought 25 years ago. I pay $4,635 each year. Right now, it has a cash surrender value of $217,000. Better than a lot of my other investments for sure. In the end, the best kind of life insurance to own is the kind that's in force on the day you die. If your policy is not in force on the day you die, you bought the wrong kind.